You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Good afternoon, ladies and gentlemen, and welcome to the latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin, and I'm a staff member here at the OIC. We're glad you can join us to learn more about options as a flexible and powerful trading tool. In our panel presentation today, Rolling with the Market, we'll focus on managing both winning and losing positions and learn some new ways to pocket a profit and lessen a loss. And as always, we'll cover the material in a quick 60-minute session. I'd like to introduce our presenter today, Mr. Joe Burgoyne. Joe is a director of the Options Industry Council and also serves as a staff instructor, presenting live and in-person options education seminars throughout the country. With more than 30 years in the business, we're lucky to have Joe's experience and expertise serve as the cornerstone of our OIC educational events. And as I know that both Joe and our slate of panelists have a lot to talk about today, let's get right to it. Joe?
Mark, thanks very much. And yeah, we have a great group, three guys with lots of experience who hopefully over the next 60 minutes will give all our listeners something to think about. Let me start actually by introducing each of them. Start with Al Brinkman. Al's principal at the Brinkman Group. Today, Al is actually representing the NASDAQ exchange as well. Al, welcome, and why don't you tell our listeners a little bit about yourself?
Joe, thank you very much. It's very pleasurable to be here with everyone today. My background, as Joe said, I represent NASDAQ, and I actually was an employee of NASDAQ when they took over the Philadelphia Stock Exchange. My career, like Joe's, primarily was on the floor of the Philadelphia Stock Exchange. I spent 20 years on the trading floor there. Basically grew up in the options industry when it started in 1975 and kind of retired in about 2010. I ended up working for the exchange for a number of years, and in that capacity is where I got into the educational piece of it, doing the seminars for the OIC as a representative from PhilX and now a representative from NASDAQ from that. So been a funny career, and options have been very good to me, and I really enjoyed giving back.
Well, Al, thanks for joining us, and yeah, many great years together on the PhilX, for sure. Dan Sherton, thanks for joining us, Dan. Dan is the owner and founder of Sherton Options Mentoring. Dan, how about if you tell our folks a little bit about what you're doing these days?
Oh, sure. Well, Joe, glad to be here, and I started at the Chicago Board Options Exchange a long time ago, I think about 1982, and I was down at the CBOE. I was a specialist at the CBOE for approximately 23 years or so, and then the last, whatever is left on that, if we bring it to the current time, whatever that is, 14, 15, or however many years, I've been teaching retail traders to do this for a living, and I've enjoyed that. I love people, and I like working on the craft together with students, and that's what I've been doing here at Sheridan Options Mentoring.
Well, thanks for making the time to join us, Dan. Boy, you mentioned 1982, and I always get a little tingle when I hear 1982 in terms of the market. You know darn well that's August of that year was the year the market bottomed, in the 700s, and right. We were both around for that. So, and last today, and certainly not least, Dave Whitmore. Dave, thanks to you too for joining us. Dave is the Senior Strategist of Investor Education at E-Trade Securities. Dave, how about if you say a few words to our attendees?
You bet, Joe. So, first off, about my title, I'm not I am a, because there's a colleague of mine, and we are both education strategists, and the point of that is simply to help our customers adopt a strategy and understand how and what a trading or investing strategy is. Period. And so, in the program, I'm responsible for our live education. So, like Joe was just discussing, we do live, in-person, and online educational events, and it can range from stock trading, risk management, order mechanics, into option strategies as well. So it's the soup to nuts. My entire career is on the retail side. So the other two guys, by the way, Al and Dan, have both spoken to E-Trade audiences as well. Interestingly, but their life is from the floor and up into that area, and I come to it from the standpoint of the retail trader. My career goes back to Waterhouse Securities, included a stint in an MBA at NYU, and then with Daytech and Ameritrade and TD Ameritrade, and I'm now with E-Trade. So that's my point of view on this, and I hope it adds a nice angle with the other two guys.
Well, thank you, Dave. And we got a dynamite topic with rolling today. Before we get right to that, I just want to be sure that everybody knows that options do involve risk, and so please be sure to, if you haven't already, get a copy of Characteristics and Risks of Standardized Options, the document put out by the industry. Also, I think most of you on the line today are aware that the OIC has been educating folks since 1992 about the benefits and risks of standardized options. And we are funded by the options exchanges and primarily really the Options Clearing Corporation, the OCC, the largest clearing corporation in the world. I think, what we're going to talk about today are, different scenarios that motivate investors to roll, or we're also going to talk about maybe when you don't roll. So we'll start by talking about potentially adjusting a long position, then a put position, but most importantly, we want to get the feedback from our three experts that were joining us. A couple ideas that just make sense before you start trading options is obviously to do your homework, try to have the discipline to stick to a plan, and certainly try to have some flexibility with regards to your account, and make sure those accounts are approved by your broker. And a lot of it is really pretty straightforward. So I think I will start, Dave, by going to you and maybe asking you to get this conversation started about your thoughts on rolling a position. Why do investors roll positions?
When we chatted about this a little while ago, about this sort of broad general question, why do we roll? It comes down to one particular, well, maybe not one, but it occurs to me that it comes down to the whole notion of time and expiration. What I mean by that is, consider a stock trade. If I'm long or short, all else being equal, there's no expiration on my stock trade. I'm long, I buy the stock, it's plain vanilla, it goes up $1, I'm up $1, all very well and good. But with options, as we know, there's an expiration date. And so as expiration approaches, we are left with a need to do something, to deal with either the obligation or the right, whichever it may be, that we're under, to deal with the time premium, and that's what it really comes down to. So, the idea really does too come around to why do we roll? It all really comes down to whether the position we have has rights, which would be a long option, or whether we're under an obligation that we might not feel comfortable with, which would be a short option. So, to me, that's the sort of breaking off point here. And I'll just, to wrap this opening here, I'll just go back to something Mark said. He made the comment in the opening about options being flexible, and it's something that we always talk about as an industry, the great flexibility. Of course, we also know that many, many, many option traders just think very singularly in terms of long puts and long calls as directional bets. We know that. But the point is about flexibility. And what we discover as we explore the types of scenarios that we're going to be talking about here, that even despite this expiration date approaching, we have a lot of flexibility with how we manage that trade and how we deal with the rights or the obligations and deal with time premium decaying and all of that. And that's what it all comes down to, is making that decision as time becomes more and more critical in the position. So that's my sort of wrap or view on that.
Okay, that's a good start, Dave. How about Dan Sharton? Let me ask you just to kick off our conversation.
Sure. I think there's a lot you can say there, and I think I appreciate Dave's comments on that. When I think of this, why do we roll? And to me, a word synonymous with the word roll is adjust, right? And so I look at this as, why do we roll, or why do we adjust a position? And a very quick answer, there's many exceptions to this and a million ways to look at it, is, hey, I want to give myself more time to be right. That's it. Why would I adjust the position? Again, there's a million things that could be said here, but just a quick sentence, give more time to be right. But what I will say is, the thing that people have to remember, men in particular, women can be guilty of this, but, from teaching for a lot of years, men would rather lose their entire net worth and their kids and their house than admit that they're stinking wrong on a trade, right? That they're willing.
Absolutely. Absolutely. So always live with the better to change your mind than lose your money.
No, you're right, and I think so. So what I see is, the number one thing when I'm talking about this concept of when to roll or adjust a position, there has to be some kind of filter, especially with male animals, as we are, at the beginning, and say, look, if I buy a June 50 call at $3, right, and it goes against me, right? Most men would roll it and tweak it and roll it and tweak it until, Fred from the casino will come over and stop them and say, hey, you don't have any more money left. Go home, right? I mean, we'll roll it till we die, right? And so I think there has to be some kind of filter there saying, look, what's the most I'm willing to lose? If I buy a call for $3, and let's just say the most I'm willing to lose is $1, right? We can't open up the floodgates and say, well, if I start this experience in life called rolling or adjusting, right, I'm willing to lose more. So I think the overall thing, what I look at in this world of adjusting or rolling, is what's the max loss that I'm willing to lose on a trade? And then I could adjust all I want, but when I'm down, if I buy a call at 3 and the most I want to lose is $1, I don't care with rolling or not rolling. When I'm down $1, I get out. And I think that's the biggest, if I had to throw like a warning out there, people get the idea once they start this process called rolling and adjusting, it's okay to lose 100 times what they normally were going to, as long as they're in this experience called rolling. So there has to be some kind of, what's the max loss where I have to leave the table and go home? Anyways, maybe a little bit too much, but that's my 2 cents.
Okay, appreciate that. How about you, Al Brinkman?
A couple of things. I mean, Dan touched on it, but I think not even just looking at it from a P&L or where to end the pain if a trade's gone wrong. I think a couple other key elements to consider in getting into the adjustment or rolling scenario for an investor. One, I think that adjusting positions is an essential skill. that if you're really into the option trading, you're going to need to learn that. It can help you repair strategies that have gone wrong or something that's starting to look like it's going wrong. You can also use them to limit losses and stop the bleeding. But you need to understand those adjustments and the proper integration, and I think that's what Dan and they were driving at. There's a time and place for this, where you're going to have to do your analysis and how to get the execution of this off. At the end of the day, understanding that, and that could be the exit trade saying, nope, that doesn't work. Things have changed. I'm out of the trade. You're going to become a more profitable option trader. So, overall, adjusting a position, rolling a position is a skill you need to cultivate, if you will. And I like to think, in my mind, I look at it as 2 categories to consider when looking at rolling or adjustments. I want to modify an individual trade that I've had on. Like Dan said, I've got the long call and something's happened. What can I do to modify it? Or in another way to look at it is adjusting an overall trade bias. In other words, I entered the trade with a bullish position to start the trade, and somewhat into the trade, the market conditions, things are starting to change. The market bias, if you will, is changing. Can I make an adjustment to move myself into a position to take advantage of that change and that type of thing with that? I don't know what else to say. Maybe, within your trading plan, Dan talks about it, I know, all the time, and Dave, you got to have that discipline. And part of that's that exit strategy, as he said. Understand the risks that you're going into and the reward. Have that detailed exit plan. And, we can go on with a little bit more of that as we go into this.
And we will, Al. So very good, guys. I appreciate it. From a, just trying to think in terms of the psychology of the investor. You get into rolling. And Dan, I'll start with you. Do you think the roll, is it typically offensive? Is it defensive? Does it matter?
Yeah, I think ultimately it doesn't matter. It can be either, but I think if the first, if you said to me the first thing I'm thinking of when I hear this word rolling or this word adjusting, I'm thinking of defensive, right? And okay. I know today we're focusing, I don't do a lot of spec trading and I don't teach a lot. I took a lot of delta neutral stuff like iron condors, butterflies, calendars, and I know today we're talking about in the context of a long call, at least some of it, or a long put. So taking that example, if I bought 10 May 70 puts at 4, when I think of an adjustment or a roll, again, I think we have to start with, if I buy 10 May 70 puts at 4, before I entertain this topic called rolling or adjusting, I have to make a profit target or max loss. Again, assuming I'm buying 10 May 70 puts at 4, we have to make an assumption I'm bearish, right? If I'm not bearish, I don't understand what I'm doing, right? Because if I'm buying a put, I want it to go down. But if I buy these 10 May 70 puts at 4, I may put, hey, I'm looking on these puts, I'm looking to make 50% on my profit. I buy them at 4, maybe I sell them at 6. And if it goes against me, if the stock goes up, hey, the most I want to lose is $2, about what I'm willing to make. I'm just giving a sample profit target and max loss. Now, within that scope, on the upside, the most I want to lose is 2. If I buy the put at 4, and immediately the stock goes up and that put goes to 3.5, and I may be thinking, you know what, I may need to buy more time, or I could be wrong here, I might sell a put against it. So if I'm long 10 May 70 puts, hey, to reduce my base exposure at $4, I'll sell a put against it. Maybe I'll sell a May 60 put against it, and that'll cut my loss, right? Or, there's many things you can turn that long put into, right? If we start going up, I could turn it into a butterfly. If I'm long 10 May 70 puts at 4, and we start going up, I could sell, if it looks like the trend is reversing and we're going up, I could sell 10 May 80 puts against it, and then buy 10 May 90 puts against it. Then I have this butterfly where the profit target is at 80. That's a lot to throw at you. But again, this concept of a defensive action is really to fix it, maybe buy myself more time, but I never get into the philosophy of rolling or adjusting as my first step. Because if I just get into this rolling or adjusting, where does it stop? When do I get out? So there has to be some kind of filter at the beginning saying, wait, as I said, I'm buying these May 70 puts at 4. The most I want to lose is $2. So if it goes up, I'm getting out at 2. If it goes down, I'll probably sell it at 6 or half of them at 6. I want to make 50%. So within that overall, risk management, now as we go up, if I want to reduce my exposure or something, I do that. But again, once I'm down $200, I get out, right? Otherwise, this rolling thing could go on until we're 92 years old. So anyways, so to make a long story short, as my Irish grandmother would say, I more think of it as a defensive trade, even though it can be anything. Thanks.
Okay. That's good, Dan. And as you said, you touched on a lot of different scenarios there. Al, your thoughts on this whole idea of offensive versus defensive?
I'm right in line with what Dan's saying. You can get caught in this and just keep going forever. I tend to look at this on a personal note from a defensive strategy with it. And I just, some thoughts I've had going into putting a trade on. Obviously, the essential part of it is to understand what you're starting with. What's the risk reward? What's your target thing? Do you have exit strategies and that type of thing? At the same time, when you're looking at it, the worst time probably is to make the decision to do a roll or an adjustment to it is when things go wrong and you don't have a plan in the bag for that happening. Stuff happens. So, you rush into a state of panic, and all of a sudden we come back to the thing. You need to know how to adjust this thing correctly. So that's that part of discipline in the trading type thing in the learning process in options. You can go ahead and say, okay, I'm going to make an adjustment. I'm going to do this. If that's an adjustment, I'm going to go long more calls, or I'm going to sell half of my position. Be careful. Just make sure you know you're adjusting the correct way. Understand the new risk reward that you're taking on, the new P&L that you're putting out there, if you will, because you could very easily, in a moment of panic, if you will, which is the worst time to do anything, is you could adjust the trade and it would be detrimental. When you sit and look at it when it's all over, you're going to slap yourself in the head and say, what was I thinking? So my teaching point, I guess, on this is, if you've planned out an adjustment or two, do the, hey, things go good, they go in my direction, do I want to make an adjustment, like Dan says, or I just want to say, hey, I was right, I take a profit, and we'll move on to the next thing. Or things go bad, how and when I'd apply that adjustment, then it might make sense to say, all right, I thought this out, I'm not doing this in a panic, I planned for something going wrong, and I've got a trade mapped out that I'd like to do on that. One other thing just to add, when you're trading, your position size, how many contracts you're doing, how much is at risk, is it within your trading plan, the risk tolerance within the trade, and the dollars committed. At the end of the day, you should be able to sustain a loss from this trade without seriously impacting your trading portfolio because you've not stepped over your bounds and done too many contracts. And now it's like, oh my gosh, I got a lot tied up in this trade. I need to do something. I need to make an adjustment, whatever it may be, on that. All that being said, the impact on your ego is another thing that might happen when you have those losing trades.
Well, that's a good point there, Al. Especially that whole idea of size of position and making sure you don't get too big in any one position. So thanks for bringing that up.
Yeah, I think a point to ponder real quick, if I may, Joe. You make an adjustment, and it may remove risk from the trade in one direction. It may add risk in the other. Or it may limit your existing gains because of the cost of adding that insurance to adjust the trade. So a lot of little factors, little points, and that's why I emphasize spend some time on this, work them out. Work out, I call it stubby pencil work in options.
Okay, well, the art of trading. It doesn't happen overnight, that's for sure. Dave Whitmore, something to add with regards to this whole offensive-defensive point of view?
Sure. A little reaction. First off, the point that Dan and Al are raising about having a profit target, having a target price on your underlying, being disciplined to stick to that, being disciplined to stick to losses. I mean, sometimes I wonder if people that listen to our seminars ever get sick of hearing all of us pound that in. It's one of the truisms of trading, but it does seem to go unheeded a lot. So, but the second point is, and both guys have been talking about adjusting, and the floor trader, the professional trader, the option trader that has the full quiver of strategies often uses an adjustment process in reacting to markets as we move around. And Dan talked about taking a long put and turning it into a put spread, and then ultimately into a butterfly or a condor. I can't remember which one you used, Dan. But if you're a retail trader, like a lot of customers that I've dealt with in my life, you haven't moved to that level yet. And the notion of rolling is sort of the first step toward the idea of adjusting. So I think it's one of those first things that option traders do encounter when they adjust. And then, Joe, to tie that back into your question about offense or defense, and both guys pointed out that primarily it's a defensive situation, and I agree. The two common scenarios for the retail guy are: I wrote calls against stock I own, and it's at the money or is gone in the money, and I don't want to lose my stock. So that's a very common roll situation where we buy back the covered call and then sell a different one in order to get out from underneath the obligation of having sold that call. And I know we're talking primarily here about long positions, but I do think probably some of the audience is thinking about that same scenario there. So that is one where it's defensive, right? We want to guard against losing the stock. I guess we didn't properly assess our willingness to sell at the strike price when we sold that call. The other way, which I would characterize as offensive, or the other scenario that I think is really handy, and it's one that's examined in your in one of the slides in here. But let's say I buy an option with 60 days to go. So we were using the June 50 calls. I'll use a 50 strike price on the calls, and we'll imagine that I'm doing this in April. So I buy 60-day calls with the intention of a move that's going to occur within 30 days. Now, that's something that we often talk to our customers about buying an extra month of time on a long option so that time decay doesn't work against you as badly if the move properly occurs in the first part of the life of that option. So in that situation, you might, so the stock's 50, let's say, and you thought it was going to 60. So let's say 30 days of the 60 have gone by, and the stock has rallied a little bit. So it's moving in the right way. Your chart pattern is still in place. You still think the stock is moving higher, but now you're approaching that 30-day period. And one of the things about what happens in the last month is time decay accelerates. So you're at risk of the headwinds of time decay. So in that situation, and it may very well be a roll that you're able to do for no debit or no credit, to go out a little further in time and potentially stay at the same strike price, roll out to a little higher strike price. And so you might have an option that you bought at 3, and a little time goes by, and now it's trading at 4 because a month went by, but it moved in price. And so rolling out to a different one for no further investment is something that you can often do and effectively gives yourself more time. Now, you face a whole bunch of other potential moving parts that are part of the later questions here, I think, Joe. So that's my take on the 3 parts of that. So thanks.
Oh, that leads me into the whole idea of debits or credits. And now, when you're doing a roll, you've made a commitment to roll. What's the mindset in terms of doing it for a debit or taking some money off the table? How do you think about that?
Oh, you want to go back to me?
I think positive.
Oh, I'm sorry.
Either
go
one
ahead.
of us, but I always think positive about taking money off the table, kind of thing, because then they have to work at it to get it back from me. I have to do something silly to give the money back, type of thing. But as far as debits or credits, it depends on what you want to do. If you're going up and out because of the pricing nature of options, moving away from the strike price but moving out in time, accumulate some additional premium. We're going to a lower strike price, if you will. So, premiums that you're going to involve in, that you're going to deal with, whether you're doing it for a debit or a credit, is time and distance. And Dave's example is a quintessential positive example of moving forward. You're gaining some more time, and you're keeping that stock in position. And as you move up and out a bit, you're building in more profitability to the underlying stock as well.
You could even leverage it at that point. You can even get a larger position, conceivably.
Right.
Exactly. And go ahead, Al.
Yeah, I just wanted to. When we talk about the roll or the position, the adjustment, however you want to use, I keep thinking in my mind, it depends on the future forecast as it relates to what your present position is, as if you want to do something and how you want to do it. Back to what I said before, the trade bias type of situation. We came in on a bullish, took a positive delta position type of that, but we've watched the market change, the underlying changes, the overall market conditions change. We're saying, is there something, can we adjust this to perhaps an option strategy or less with a strategy position that allows us to take advantage of a downward move, for example, on that that's happening, so we're not entirely out of it. That being said, obviously, if our underlying forecast and we feel we're wrong, the first place I would look is okay, it's not working, let's move out and take a different strategy. That doesn't mean, however, you can't make an adjustment to have a position that has an advantage to the revised forecast, and that can come in that way. I think the key point, though, end of the day, on how we do this, change in risk reward. You got to fully understand it. Okay, I've done this. What has changed now? Do I have an additional risk and reward scenario? Have I lessened the reward, taken a little bit of risk off the table? That's usually a trade-off that you have. Or have I inadvertently taken on more risk? And the P&L dynamic. I know we're going to get into P&L a little later in that. So, what that adjustment creates is a real key element.
And Dan Sheridan, do you have a particular take on rolling up and spending money or taking money off the table, rolling down? What are your thoughts?
Yeah, I don't, if we're looking mainly in the context of a long call and put, right, Joe?
Yep.
So in the context of a long call and put, I think, the first thing I think of, let's say a long put, the market right now that we're in today, the SPX is at very high levels, right? I don't know what the SPX closed at today, but, we're probably within 40 points of the all-time high in the history of civilization, right?
Call it 2160.
Okay, so 2160, and what's the highs of all time? 2193? Is that about right, Dave?
Let me see here.
So we're
2183 or something like that last week.
So we're roughly in the upper end.
Oh, I'm sorry, 2193. You're right.
Okay, so we're within 30 points of the highs of all time in the history of our United States, right? And the VIX is at pretty low levels, right? So with that scenario, if I'm buying a June 50 call, right, at $3, and we're in this environment, especially if it's in an index or SPY or whatever the vehicle, I'm quick. I'm ready to, if it goes against me, especially being in the environment where my first choice would be maybe sell a lower strike call. So if I buy 10 June 50 calls at 3, hey, I'd look to maybe sell the June 45s or the June 40s if any kind of resistance or any kind of support is broken, because we're at these all-time highs. Now, I like the fact that I'm buying a call or a put in this environment because premium levels are pretty low relative to where they've been. Now, if I'm buying a May 70 put at $4 in a stock, and most stocks are kind of in the upper end of the range, right, along with the market. So if I buy some May 70 puts, the thing I'm really looking to get benefit from is the cheap time premium. But as far as what the adjustment be a debit or credit, again, it's a debit to buy a May 70 put at $4. Again, if I'm wrong and we don't go down, I'm looking to turn this May 70 put into a bull put spread, bull put credit spread. By, if we start going up, I would sell maybe 10 May 80 puts, and I'd end up in a bull put credit spread. So I turn this debit spread into a credit spread. If we go down, I buy the 10 May 70 puts, and we go down, I buy them at 4, and maybe the puts go up to 5, and I'm still kind of thinking that we have some more room on the downside just to lock in some profits. I might sell out 10 of my May 70 puts, so reduce my debit. I'd sell some puts, so I'm bringing in a credit, maybe sell half of them depending on what was my initial profit target. Or I might sell 10 of the May 60 puts at some point on the downside against it, just to lock in some profit. So generally when I'm buying a call or put, I'm selling something, bringing in a credit against my initial debit.
And Dan, I'm going to come back to you, and Al and Dave, feel free to chime in after I go here with Dan. So, Dan, we're talking about being long 10 calls, long 10 puts, and then in some examples you were talking about turn around and selling, 10 calls or puts to kind of offset. Okay, and we get that. That puts you into a particular vertical spread of sorts. Do you ever think in terms of dollars invested? So rather than going, into that spread, 10 to 10, you're looking at the amount. Let's say, let's go back to the calls. We're long 10 at $3,000. 10 at 3, which is $3,000. Might you sell the same number of calls to offset that $3,000 investment, but they're higher priced calls, so you sell fewer of them? Do you take that approach, or you kind of stay one for one in your spreads?
Oh, you mean like for an adjustment?
Yes.
Okay, so what Joe's asking, if I'm going to make an adjustment, will I, let's say,
basically trade the money as opposed to the one for one spread. You follow me?
Yeah, I mean, when I'm trading spreads, and 100% of the time I'm trading spreads. I'm not trading long calls or puts, so, unless maybe I'm buying a call and a put occasionally, maybe a long straddle or strangle, but I'm usually doing like maybe a calendar trade or a butterfly or an iron condor or something like that. So so many times if I have 10 spreads, I might adjust by only doing 5 because I'm looking at my position deltas as a signal to me how much. In other words, my position deltas, and when I adjust, that's going to determine, if I want to cut my position deltas in half, that'll determine, do I sell out 5? Do I sell out 4? Do I sell out 6? But in this example of buy 10 June 50 calls, yes, I do look at, as Joe mentioned, it's a $3,000 trade, right? I buy 10 June 50s at $3. That's a $3,000 trade. So, I don't particularly look. I mean, I could. I think again, everything is driven by what's my profit target and max loss. So let's say, for example, I buy 10 June 50 calls at $3, and we go up to, and my goal is to make $2. right? So my goal is for these calls to go to $5, and then I'm getting out. My max loss is if they go from 3 to 1, I get out. But let's take a scenario. I buy the 10 June 50s at 3. They go up to 3.5, right? 350, 370. It's not near my profit target, but things are looking to change, right? Maybe some news came out on the stock, or maybe some news that I think could overall affect the market that I'm kind of reassessing my plan, and I'm getting a little bit of cold feet, because of maybe some things that have come up in the market. I don't think we're, I'm hesitant that we're going to get this chance for it to go from 3 to 5, which was my initial target. Well, I might start lightening up, and that would be a case if I'm long 10 June 50s. If I'm getting a little bit of cold feet, I've got a little bit of profit, but I'm getting a little bit of concern that we might not hit my target, I might sell 5 of the June 55s against it, right? Or 5 of the June 60s, or sell out 5 of the June 50s.
Yep.
I'm looking at that dollar amount. So that would be my at least a example.
And I don't know if Al or Dave, you have anything to add just in terms of that thinking in terms of dollars, which almost gets back to the whole debit or credit for the roll, as opposed to Dan talking about staying 1 for 1 in the spreads.
So I'll a quick reaction to that. I'm not a huge fan of throwing more money at the trade. You got a position that's coming up, and in my example, again, my view is I want to try to get out of a long call with still 30 days of life left. Buying more, pouring more premium into it, to me is probably the wrong way to approach it. So my view would be at that point is that you're either going to roll to take some money off the table, so to capture some of your profit or to reduce your cost, in which case you'd be rolling for a credit, or the other way is to leverage the position and take all the proceeds and load up on more contracts of a further out strike and be more leveraged to the move. So those are the two things that you're sort of presented with when you've got this long call situation. The one last thing, and I don't know if it fits with the debit credit notion or not, but it's one of those things as a brokerage guy I want to bring up, and something that some folks don't recognize. When you're rolling, but let's say you've got a long call, when you want to roll that, you can just go ahead and sell that call as a closing transaction, and then pick another option to buy, and you can do it that way in 2 discrete trades. Or you can do it as a spread, and what I mean here is as a spread order, not as a spread position. And all that has to do with is whether the transaction is opening or closing. So in most brokerage firms, and I'll just describe how it is at E-Trade, if I'm long 10 June 50 calls, and come June 1st, as I'm making my decision to roll out, I'm going to sell the June 50 calls, receive credit for that, and then and that's going to be a sell to close, and then my buy side is going to be a buy to open another contract, whether that's up and out or whichever strike or expiration we're dealing with, and that's going to cost money. So it's a spread order that you are placing that's not going to result in a spread position because one side is closing. So that's a common misunderstanding or misconception sometimes on the part of retail traders. The last thing I mentioned is this idea of legging, moving the position one leg at a time. Various situations that can arise for that. I'm probably going a little bit off topic and into the weeds a little bit here, but it's my view of this idea of debit and credit and which one do you want to go for.
Into the weeds, in a panel is I think a good thing, Dave. So thank you.
Not a good thing. I tend to be on Dave's side of the ledger a little bit, and I also agree with Dan. Don't want to go that way. If I'm spreads, I'm going to be doing kind of one-off unless I'm doing a ratio spread specifically to start off the trade with that. But I think I like the idea that using a monetary situation, I think, is something to look at, to step back and take a look at on your plan. And like we said, you get your stock, you have a target price over a period of time and you've not quite gotten there, but you still maintain bullish, but you're running out of time on your option position, time to take that off the table, reduce the number of contracts perhaps to reduce the premium on the rollout scenario, maybe staying at the same strike price from it, and you've actually, you know, taken in a credit on that kind of a trade perhaps as the way it is, and again, using it for the number rather than the number of contracts, if you will.
Okay. You know, we've beat around this question a little bit. I haven't asked it directly. I will now. You know, how about if we talk about, and Dan Sheridan, let's try to keep gender out of this, you know, whether we roll a position or close a position. All right. You know, we have talked about it, but, you know, what do you think is the deciding factor, or deciding factors in deciding whether to close a position, either for a profit or loss, or to roll? And how about if, Dave, I start with you on this one?
Well, I think my first consideration there is what's happening with the underlying, and did it reach your target or not? And that's where the analysis has to start. You know, if you've reached your target price and it's happened as you expected, you know, rake those chips back off the table and find another trade. If you're in that no man's land where you've seen a little price appreciation in the underlying, but time has faded, so you're kind of in a push situation. You know, that's a perfect example of rolling. You know, the other, when I first led off, I said a lot of this all has to do with time value and time premium. You know, if you are a buyer of calls, but you buy in the monies, deep in the monies, you know, Apple's $112 stock right now, and you know, if you want to trade the 100 calls, they're like $13 or something like that. They have like all of 50 cents of time premium in them for, and I'm looking at a November right now, on a $13 option. So the time premium issue isn't as big, and it doesn't decay as much. And even as you get down closer to it, your option price is going to react close to the underlying. In that situation, the whole rolling thing doesn't create as much of an issue. So a lot of it all begins with, you know, how did you start off? Are you an out of the money call buyer? Well, that is where this can become, you know, much more important. So that's my basic take on it. You know, what's the time premium left? How do you want to contend with that? And did you reach your target? You know, where's the underlying?
Dan, your thoughts?
Yeah, I'm pretty much right in line there with Dave. The way I look at it is, again, taking that example of, you know, if we take that example of buying 10 May 70 puts at 4. So to me, here's how I look at it. Again, starting with that overall plan. Hey, I buy these puts at 4. I'm looking to make $2 on it. If it goes, it's 50%. If it goes down, I'll sell it at 6. If it goes up, if the price of the underlying goes up, and I lose $2, right? They go from 4 to 2. You know what? I get out. So that's when I would close it. So I have what's directing this trade is my overall profit target and max loss. So if I hit $6 or $2, I close the trade either for profit or loss. Now, let's take the upside. Let's say it starts going up and that put goes from 4 to 3, right? I'm not at a max loss. My max loss is if it gets to 2. At that point, it's at $3. If I want to buy some more time, right, before to give this stock a chance to go back the other way, right? I buy the May 70 puts at 4. I think it's going down. It does just the opposite. The stock goes up. This put goes to $3. Well, at that point, I'm thinking, stock looks like it has a little bit of momentum to the upside. You know what? I need to buy some time, or, hey, this put goes to from 3 to 2, it hits my max loss, I got to get out. I want to stay in the trade. So at that point, maybe when the put goes from 4 to 3, at that point, I may consider adjusting or rolling because there's still time. I haven't hit my max loss, and maybe at that point, maybe I sell a few. I don't have to sell 10. Maybe I sell 3 or 4 May 80 puts, get a little bit of help. If the stock is continuing to go up, it keeps me in the game longer. It keeps me away from my max loss to maybe buy some time for my forecast to work. So that's kind of how I look at it. I look at the whether to close a trade or not is based on this overall plan, but this rolling or adjusting is then one step underneath that, but it doesn't supersede it at all. Once I hit the max loss or my profit target, game's over, right? I have to keep that discipline of trading. And one of the big sayings in the pit was, I want to trade to, maybe I'm saying the words wrong. Maybe Al or Joe can help me. What's it like? Trade. I want to make it another day. Trade to I'd never would do that. What's it called?
To live again to fight another day. Here.
Yeah, that's it. Yeah.
Amen.
Yes.
That's it.
Yeah.
And I agree with Dan 100%. And based on experience on my own side doing the trading, I was more on the brokerage side, but Joe was in the trading side. That little bit of discipline that you need to, particularly when you have a losing trade, and I will go with Dan's analogy here, it's like guys asking for predictions. Don't worry about it, dear. I know exactly where we are. It's tough to do. It is a tough psychological barrier to step over and, say, I'm going to stick to my guns. I made this trading plan, and I said, if I'm down 2 points or whatever the case may be, I'm out of here, and I'm not going to try to mess with this because I'm probably just going to make it worse a lot of times.
Yeah, trade to play another day. How'd you say it? Yeah.
Yeah, live to trade another day.
Live to trade another day, yeah.
Nothing more important than that.
No.
Absolutely. Don't get overextended. I'm sorry, I didn't mean to interrupt with that. Please continue.
No, Al, that was spot on. And you actually, earlier on, Al talked about, the size of positions being so important, and that's basically, what we're talking about here.
Yeah, you've got to be able to live from a bad one or one that goes wrong. One other thing I'd want to add, and Dave really touched upon it, on adjustments, and one of the key things I think is time in making the decision to make the adjustments of the essence. We all said at any point in time, all of this comes down to your forecast for the underlying, for time, distance, and how much it's going to move over what time, obviously in options. But inside of that decision, inside the time that you have the position on, and things start to change, whether a positive or negative type of thing, and you want to make that adjustment, being careful of trying to do it too early in the scenario, where you're reacting to a sudden change in market movement, and those of us, a lot of us are do technical analysis type thing, and you look at a confirmation that the market or the individual security has in fact changed direction, or a confirmation that it's achieved a breakout or something of that nature. So going in there before that and then waking up the next day and finding out it was just that temporary, markets do that kind of thing, that little jump here, that thing there that kind of gets you off your game. It's like the snap count. You jump off sides type scenario. So timing, I think, is very careful, and you need to have within your trading plan, put that discipline back in there to say, I need to, confirm in my own mind through some method, however I do it, that we've changed direction in this particular underlying, or that it has confirmed its continuous move upward, and we can adjust to take advantage of that as well. And then, the other side of that trade is waiting too long for that to happen as well. So not easy either way.
Well, once again, the art of trading, Al, and in subsequent months, I think we'll be getting into some of that. What strike, what month. To me, are the two key questions. When trading options, and I think, it's just it's part of the art. Hey, Dave Whitmore, I want to just have you confirm, if you would. Let's, we've been talking about a long call position, a long put position, but let's say, as Dan Sheridan's been referring to, you got a spread position on, and let's say you want to roll that spread position. Do investors, should they roll those spreads as a spread? Should they do them individually? What are the capabilities of the brokerage firms, and what are your thoughts on that?
Well, sure. So to go back and sort of echo what I was saying before about this idea of rolling a long call by using a spread order on your brokerage firm order interface, let's go back and now talk about spreads. So when you put a bull call spread on initially, you were buying we'll use our stock, our $50 stock, so June 50s. So you would buy the June 50s. In this case, let's say they were 3. I think that was the example we were using. And maybe sell the June 55s. Maybe you take in $1. So so it costs you 2. Sold for 3. Bought for 3. Sold for $1. Costs you 2. You've got a 5-point profit potential. When you put that order in as a spread, the buy is to open and the sell is to open, creating those 2 open positions, one long, one short. When you then want to roll your position, you're going to be selling the 50s, buying back the 55s, selling a like number of the 55s, and then buying more of the 55s and then selling the 60s. So to roll out into a 55-60, if that's what you were doing. So most brokerage firms will allow you to do that in a variety of ways. You could use that as I believe you could put that in as a butterfly that would result in a new call with different opens and closes, or you could put it in as 2 spreads. One consideration here is understanding the brokerage firm's commission structure on complex orders. So at E-Trade, ours are pretty straightforward. It's a $9.99 base charge, which is the same as our stock trading charge, and then 75 cents a contract on the various contracts of the legs. So that's something to consider if you choose to leg in or roll out individually in the way I was examining it. So it really should be fairly straightforward, though. If you're a spread trader to begin with, then you're used to the idea of 10 contracts on this side, 10 contracts on that side, one's to open, one's to buy to open, sell to open, etc. So it's just a matter of manipulating those buys and sells and opens and closes to result in the outcoming trade.
Okay, good. Thanks for the clarity there. I think, guys, we're banging up on the time. We do have a lot of questions coming in. I'll grab one here. Question coming in asks and Dan, I'll start with you. Is volatility a factor when rolling a position?
Oh, yeah. I think, it comes to, when we think of rolling or adjusting as part of the plan, we have, okay, this is the point. When stock goes to X point, up or down, hey, this is where I'm going to adjust or roll. So once we get to that point, right, then I stop and I say, okay, this is about the point where I may be looking to roll or adjust, okay, based on my overall plan and my analysis at the beginning. But once we get there, right, I'm going to look at the price levels of the market. I'm going to look at the implied volatilities, and then I'm going to make an assessment. So right now in the current markets with VIX at, I don't know, maybe someone could tell me, where did VIX close at today? And again,
1310.
So 1310 to me is still in the low end of the range. SPX or VIX is in the low end of the range. In a lot of stocks, their implied volatility is in the low end of the range. So if I'm looking to make some kind of an adjustment or roll, I'm considering maybe something where I'm buying premium. So for example, well, if I'm already long a call, I'm comfortable because it's the environment, but I might be looking for, as an adjustment, maybe a debit spread where I'm buying the at the money and selling an out of the money with less time premium. So, like buying a debit spread where the option I'm buying is more time premium than the one I'm selling. So yes, I look at when I'm adjusting or rolling, I will look at the price levels, the volatility levels, and then say, hey, based on that, which adjustment will best fit with the price level and the volatility? And a very important thing, Joe, which I don't think retail people look at enough, is when you make an adjustment or a roll. I think Dave touched on this earlier. I don't want to, if I got a $3,000 trade, I don't want to make an adjustment. So if I buy 10 calls at $3, I've got $3,000 of risk, right? That's it. Not that's it, but that's my risk. I don't want to make an adjustment that's going to double my risk, right? Some people I see are willing to make an adjustment, but they don't look at, well, what does it do to my margin or my capital or my risk? And so I think it's very important, kind of that triangle, look at the price levels of the market, look at the volatilities, and then when you make an adjustment, okay, does it do what you want? Does it maybe reduce your risk or your delta exposure? But the bigger thing is, what does it do to your capital, right? And I think, you have to look at all the elements of it. So that's my 2 cents.
Okay, and again, Al, I'll go to you. The listener question was, is volatility a factor when rolling?
Joe, at that point when you said that, I had these vivid memories of a seminar that you and I did on the 10 questions you're afraid to ask. And the topic was rolling into a volatility thing, and you gave a very eloquent and impassioned case for volatility matters all the time in everything we do in options. And I'm going to stand by that type of thing. The answer is yes, it does. It needs to be from the start of your trade, when you initiate the trade, look at putting the trade on, and then as the trade moves forward, you've got to keep that eye on it, on the volatility overall, market, individual, security, whatever it may be. And then if you get in a position where, okay, the roll or the adjustment may be an appropriate strategy, you've got to start to look, once again, it has to be a part of your calculation, if you will, on making that decision.
Very good. Dave Whitmore, anything to add?
Well, first of all, it's sort of the same thing Al chuckled at. Volatility is a huge factor in the price of options. Unfortunately, for most retail guys, it becomes something that's very difficult to predict. So what I would suggest is that option traders really try to grasp how changing volatility does impact prices by using a couple tools that are probably available. And at E-Trade, they certainly are. So, if you don't have the ability to look at a chart of implied volatility for an underlying stock and its related statistical or historical volatility, if you don't have chart capability to do that, you should, so that you should be able to know whether the underlying stock you're looking at and its options complex are in a high volatility and therefore high time premium situation or low. Because how you react to those prices should depend to some degree on that part of the curve. Where are we? Are we in rich option prices or cheap option prices? And you absolutely need to know that. So, as I said, Dan made reference to asking about the VIX, and that was his shorthand way of saying, look, the VIX is very low compared to where it's been, and I'm looking at a 4-year weekly chart, and it's in the lower end of a range, with spikes into the 20s, setting aside the real high ones. But he's right, we're in the low end of the range, and what that implies is that option prices generally are relatively low right now. So You need to know that environment as an option trader. And, I'm sure most of the audience knows that E-Trade's in the process of acquiring and merging with a great options platform, Options House. So we're looking forward to even more tools like that as we move down the road.
So listeners, those vol charts certainly you can find on the E-Trade website. We have them also at optionseducation.org in the drop-down under Tools and Resources. That would be historical and volatility charts. Fellas, we are going to have to wrap it up here, but I want to give you each up to 30 seconds with final thoughts. Al Brinkman, how about you first?
Essential skill. It takes time. You need to know how to adjust correctly, and you need to spend the time to learn that. Do some practice trades. Do the paper trades. Don't dive right into it, and don't do it in a panic situation. Next.
Outstanding. Dave Whitmore?
So yeah, two quick angles on rolling. One, if you're a long option trader, if you're a long option buyer, call buyer, put buyer, don't hold your options all the way to expiration unless you're a deep in the money buyer where the time premium you bought didn't matter that much. So what that means is when you're thinking about rolling as being an item in your toolkit, think of that at about 30 days. Buy enough time to give yourself an opportunity to trade out of it with at least 30 days to go so the time premium hasn't decayed. The other flip side is if you're a covered call writer, and if you're in that last week and it's close, consider paying the few cents to get out from underneath your obligation, because I know that's the skitterish point that covered call writers often reach when they fear losing their stock. So that's my quick 30-second 2 bits.
Dan Sheridan?
Yeah, my 2 cents would be, look, if you're a beginner, and I would stick with, if I bought the 10 June 50 calls at $3, hey, if I'm a beginner, hits my profit target or max loss, get out. All right? If you're going down the roll of rolling or adjusting, it's a little more assumes a little more knowledge. I'd get more education, learn the Greeks better, because I think if for a beginner to go down that road of adjusting or rolling could be like a Three Stooges adventure. So make sure you really understand how options work, understand the Greeks and deltas and different things before you start this journey called adjusting or rolling. Walk before you can run.
Mark, I want to turn over to you. I want to thank our listeners. I know we went a little bit long, but Al, Dave, and Dan had an awful lot to offer. So, Mark, back to you.
Well, they certainly did, Joe. And from the comments coming in, people certainly enjoyed the presentation and the information that our 3 panelists, Joe as well as you, were able to provide for everybody. And ladies and gentlemen, I wanted to thank you as well for taking the time to join us today. It does look like you enjoyed the presentation, and I'm glad that you're able to take away some great tips and some keys, some great key ideas to managing your positions. Should you have any more questions, we do have our investor services desk ready to help, and you can reach out to them at options@theocc.com. And please don't forget to follow us on Twitter at options_edu and like us on Facebook. Thanks again for attending, and we hope to see you again next time.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.